Hi, this is David with the Enzo Trading System. This is going to be another update regarding short side trading, the work that we started doing, I don't know, a couple of months ago to implement a strategy that would work on a bearish markets such as those that we're seeing these days. So we're not yet broadcasting the signals, but I think we have an algorithm that works fairly well. We're still doing some testing. There's still some things to iron out, but overall, I'm pretty happy with what we have, and hopefully by the end of the month we should be able to share those signals with everybody. So here I have I can make a quick overview. On the left side, there's all the markets that we've been trading recently, and in this case, of course, there is no position open on any of those markets because they're all very much in bear mode. On the right side here, I have instead a signal generator that as also in the ensemble of algorithms includes one that works on the short side, and in this case it would have produced five signals, short signals. They're all positive right now, of course. Fairly easy considering how much the market is dumping. So that's a preview, I guess. What does it look like? I suppose we could see maybe BNB, and that would be a short trade where the arrow in this case goes down, meaning that it's pointing to make a profit on the downside, and there's currently an open position that would be at plus 13% profit to be multiplied by leverage. So that would be really nice to have finally implemented and running on a fund. Right now, I mean, the focus is still going to be long term on the long positions. I think short trades, they're more of an exception rather than the rule. Of course, any healthy market worth trading, it's going to be going up more than going down. So I think short side should really be considered as an exception to do some extra income, but the behavior on the long side is still more important, and I think the bulk of the profit is going to be on the long side for the future anyway. And one example of a good long trade, it was on TRX very recently, while all the markets were already dumping. TRX was actually doing well, and actually we could make good of this positive movement, and we made a trade that was about 15-16% profit, followed by small loss. No big deal, but this one actually so far made the month. If we look at the state of our reference fund right now, we're in the positive, and the big profit this month really came from TRX for this position that was open for, I don't know, 5-6 days, and we had the plus 60% on the position, because this reference fund is for time leverage, so it's 15 by 4, about 60%. So yeah, when is this going live? I think by the end of the month. And besides that, I would like to talk about a little bit more in detail some things I already mentioned. One thing I didn't mention, I think we came pretty quickly with this algorithm. I didn't want to rush it. It's really important when doing research and development. Yeah, there's a lot of development that is fairly linear, maybe painful, but one pretty much knows what has to do. When it comes to research, actually kind of the more creative part, that of developing an algorithm, adapting existing indicators, developing new ones, and interpreting the testing data and all that. It's important to have take 1, 2, 3 multiple looks at the same things at different distance in time, so that one has sometimes a different perspective. it's very important to focus on things for a while and then break off and then go back again and see if things still make sense. So that's to say that this algorithm that we're going to publish actually was, I don't know, mostly complete maybe 1 month ago, but with a fresh and second look, we were able to do those, take those extra steps and really verify that is indeed something worth publishing. And I mentioned already that we're still focused. I mean, anyone should be focused still mostly to make profit on the long side. It's important to not expect too much from this short side. It's secondary. There's going to be some additional profit, sensible profit in some cases even, but it's not going to be really the focus of things. It wouldn't be the healthy thing to do. So that's pretty much it as far as this update goes. I would like to add something else, which is more on the technical nature. Some kind of a last issue that we're dealing with. I want to mention it because I think it's kind of interesting. It's a bit, I mean, initially it was a bit scary. It may warrant a deeper analysis, but so what is it? Basically that when we do backtest, we realize that using the spot market price data seems to lead to better results than using the futures price data. I looked a bit into this. I didn't really do an in-depth analysis. Maybe someday we will. My guess is that spot market data, it's inherently more organic, whereas the futures market data has some added entropy to it. There is some additional movement that happens on the market, on a futures market data that is related to things such as the funding rate, which is an event that happens every 8 hours, at least on with perpetual futures. That kind of gives a kind of different market movements at the higher frequency. There is also liquidations that can drag the price down or up, I guess in a way that is a bit more violent than on a spot market. And all these added events, they amount perhaps to a bit more entropy, meaning a bit more volatility. And there is at least one case that I noticed is where you end up with a stop loss, a spurious stop loss, which means when perhaps a certain price, certain risk level is reached, the algorithm, the stop loss set forth by the algorithm, by the risk management system, kicks in, and then perhaps the price bounces back, and it's basically a waste of potential profit. And this would happen in some cases, a couple of cases that I noticed, because the wicks of the futures market were a bit more pronounced, meaning that the price movement was a bit more amplified, at least at the minute level candles. One way to go around this would be, it is something that actually we already do when the algorithms, when the algorithms are live, we look at the high frequency data, and that would be sub-minute data, and that allows us to determine whether some price movement is only lasting a second, a fraction of a second, or it's lasting more than that. So if it only lasts, I guess within 1 or 2 seconds, it's sometimes, oftentimes, is a price movement that can be ignored and shouldn't be triggering a stop loss. If it takes more, then it's probably more sure, and then a stop loss should kick in. But again, this is something that we only do live, and we cannot do it in the backtests and the training phase, because we remove the handling of high frequency data in those cases. The reason being is that it's just too much data. If you're dealing with many markets, we're dealing with 19 markets, 2-3 years worth of data at high frequency is prohibitive. and it's basically not worth the effort. And that's again only one case. How really spot market and futures markets are different. It could warrant a deeper analysis, but what we're going to do right now, even on the futures market, even if we're doing a short side, we're going to stick with the spot market reference, which is the underline. It only makes sense that one should rely more on the spot market. Why that happens in detail, I guess it's a story for another day. But this is just a technical thing that I wanted to share for those that may be interested. Maybe somebody has a different opinion, something to keep in mind. As far as the user goes, this doesn't matter at all. We'll just, it's something that we'll have to implement ourselves. And then once that's in, we'll do some additional live testing, and then finally we can distribute this new version. So that's it for me. Until next time, have fun. See you.